Good afternoon, everyone, and thank you for joining us today. My name is Christina Rose, Director of Strategic Alliances at Foundation Source, and I will be facilitating today's webinar discussing how private foundations can help families achieve their charitable goals and support their overall wealth planning. I'm pleased to be joined by Josh Stamer, Foundation Source's Senior Managing Director for the Southern Pacific region, and Simone Devenny, Vice President of Wealth Strategies at Eaton, Vance. I will introduce them in a few moments, but first wanted to touch base on a few points. Since March, I've begun each webinar by extending my best wishes to you, your families, and your communities. It's been a difficult year, to be sure, and it's hard to believe it's now November and we're still facing so many of the same challenges. I truly hope you and your loved ones are all healthy and well despite these challenges. And on behalf of everyone at Foundation Source, I hope you have a meaningful Thanksgiving holiday in whatever way you will be celebrating this year. One of the positive consequences of 2020's hardships seems to be a recentering on family, of bringing people together for a common cause and a desire to build a philanthropic legacy. We hope today's discussion will help you prepare to navigate these conversations with your families and clients as we approach the end of the year. For anyone not familiar with our firm, Foundation Source is the nation's largest provider of comprehensive support services for private foundations. Our services include administrative support, active compliance monitoring, tax and legal expertise, online foundation management tools, and philanthropic advisory services. Now, before we fully jump in, I wanted to say a quick word about Wi-Fi and phone connections. Probably like most of you, we are working remotely. We don't anticipate any technical issues during the broadcast, but if one of us loses connection, just know we will quickly get it resolved and resume the webinar. If you experience any problems, you can try exiting and then rejoining the broadcast. Also, audio may be better via phone than on your computer. It will also reduce the strain on your Wi-Fi connection. Questions can be submitted at any time via the GoToWebinar dashboard on your screen. We will be leaving some time at the end of today's presentation to address your questions. If we do not have time to answer all of your questions, please know that we will follow up with you directly after the webinar. Also, there are a couple handouts in the handout section of the dashboard for you to take away today. One is a piece with additional information about Foundation Source and who we are, and then there's also a foundation planning guide for advisors. And now it is my pleasure to introduce Josh and Simone. Josh Stamer is Senior Managing Director for the Southern Pacific region, where he works closely with private wealth managers, financial advisors, attorneys, and donors regarding their charitable goals. In his role, he draws upon his background in both client services and the financial sector. Josh previously served in sales management roles at Workiva and Maxwell Systems, Inc. At Workiva, Josh helped lead the company's entry into the West Coast financial services market, developing trusted partnerships with banks, insurance companies, and hedge fund organizations to support their clients. Josh holds a degree in business management from California State University, Long Beach, and the University of Wollongong in New South Wales, Australia. Simone Devenny joined Eaton Vance Distributors in 2020 and serves as Vice President and Strategy Specialist in the firm's Wealth Strategies Group. In her role, she consults with internal and external partners to craft solutions for many client challenges, such as tax-efficient planning and charitable giving. Prior to Eaton Vance, Simone was Executive Director, Ultra High Net Worth Planning Specialist in the Family Office Resources Group at Morgan Stanley. There, she advised and educated in the areas of wealth transfer, business succession and exit planning, philanthropy, and family governance. Simone has also held positions at BNY Mellon Wealth Management and Fidelity Investments and served as a practicing attorney and tax consultant. Simone has a bachelor's degree from Boston College and a law degree from Boston College Law School. Now, to get us started today, before I turn it over to Josh and Simone, and as they get their cameras up and going, I wanted to get us started with a quick poll to kind of see what you've been experiencing this year. So we'll keep this open for a moment and just go ahead and select what you've been seeing in your practice or in your families throughout 2020. We'll give it another 10 seconds here, and then we'll close the poll. All right, let's go ahead and close the poll. All right, let's see. There we go. All right, so what we're seeing is that 41% have seen it increase a little, and 22% quite a lot. And that's certainly what we've been seeing at Foundation Source as well. So right now, Josh and Simone, I'll turn it over to you and take it away.
Perfect. Thank you, Christy. Hey, Simone, how are you?
I'm doing great, thanks. How are you?
Terrific. And Christy, can you hear both of us okay?
Yes, I can. Perfect.
Excellent. Terrific. Perfect. I got excited there. You almost gave me a master's degree. I don't know if you know that, but it would have been terrific. I would have taken that.
The easiest master's degree you could ever earn, you know?
Well, I thank you. I appreciate that. Very nice of you. So Simone, thank you for joining me in our webinar today. We've had the opportunity to work together quite a bit over the last 5 years or so, and it's always a pleasure getting to present with you.
Thanks
Yeah, you got it. As Christy so eloquently introduced, our topic today is a wealth strategist perspective, achieving financial and personal objectives with a private foundation. So to set the scene for today, let's tell our audience a little bit, kind of in our own words, about our roles and our backgrounds. Do you want to go first?
Sure. So I am a high net worth strategist, essentially helping families and individuals with their estate and charitable planning goals. So just trying to understand what's important to individuals and their families from both not just a tax perspective, but also from a legacy perspective, and really helping clients define what that looks like for them by sharing some best practices around what others are doing.
Terrific, thank you. And a little bit about myself, as Christy mentioned, I'm the Senior Managing Director with Foundation Source, leading business development here in the Southern Pacific region. I'm based in Orange County, originally from San Francisco. And much like Simone, my primary role is to work with both clients and their trusted advisory teams, which obviously include wealth management specialists, attorneys, CPAs, and their additional networks to really achieve impact and fulfillment in their philanthropic goals. But what's nice is what we're going to be talking a little bit about today, Simone, obviously kind of transcends just the philanthropic approach, but also brings up how, certainly from a wealth management perspective and an investment perspective, how both philanthropic and personal goals can align kind of through the vehicle of a private foundation specifically. So Simone, I know, knowing you, I know I can say with kind of a great deal of confidence that the best parts of our roles are really the opportunity to work with the clients, and as I mentioned, their extended teams, to not only help them achieve their goals in the short term, but also in the long term. Impact and fulfillment in philanthropy kind of comes with planning. It's really kind of one and the same as far as the conversation goes. So this is obviously an enormous undertaking in talking through in a 45-minute or so session, but hopefully we can leave our audience today with some takeaways that they can apply to their own conversations that they're having with their clients or their trusted advisors. So maybe in true kind of Josh and Simone fashion, I know that we can make this a fun and informal session because that's typically where the majority of our best ideas tend to come from. So maybe let's jump into our first topic, and I'm going to throw this up on the screen just so we can kind of have a little bit of an outline for our clients. But the first thing that I'd like to talk through today is the idea of timelines and why timelines play such an important role in both the planning process, but also the conversation that our clients and their partners are typically having with their teams. So maybe let's talk a little bit about, Simone, your opinion on kind of when the conversation of charitable giving should happen, when does it happen, how are you seeing this done from a best practice perspective, et cetera?
Sure. So I think interestingly, historically, I think charitable giving conversations have often been had toward end of life, right? So what we frequently have heard, and actually not historically, still today, a lot of people saying is, you know what, I definitely have some charitable intent, but I'm just going to make plan for that in my estate plan after I'm gone, right? Right now, my goal is to provide for myself and my children, and I really don't want to think about that, yet, for whatever reason. I think some of it is, the reluctance to get involved while they're alive, because they think they can just put it off, and it's just just like estate planning in general. And I think that that's something we're trying to help people change. One of the benefits, we really think that philanthropic conversation should start very early, as early as even with young children, like maybe allocating some funds to young children and having them sit down and have a conversation with the family about what are some charitable organizations that you like. Do you like animals? Do you like the Girl Scouts? Whatever it might be, but really helping to educate kids around philanthropy and making it part of the family conversation earlier rather than later.
Yeah, it's a good point. I think in many things we can obviously point to the obvious and saying early and often, like many things, but life happens, right? Things get in the way, priorities arise, and certain other conversations get deprioritized, but this is really an important one. The idea of charitable giving as one piece of an overall estate plan, even in recent memory, a lot of what we've seen in the news with Prince and some other very public figures not having maybe the fully developed estate plan that they should, really can create a lot of problems down the line. So that idea of really prioritizing that conversation, I think, is really important as far as a takeaway. Talk to me, you touched on this a little bit, and I know we're going to get into some of the specifics around kind of the idea of giving while living versus testamentary, et cetera. But what are you seeing with your clients from the perspective of deciding who takes part in this conversation? Is it predominantly, your clients who are wealth creators? Obviously, the benefit of bringing in extended team members, but talk to me about, family, children, where you're seeing these conversations driven.
So it's really interesting. I think that there's a spectrum. So what a funny or not so funny story. This is a real story. So I'll give the one extreme. I actually had dinner with a client about a year ago, and her father had sold a company, was a billionaire, and he had passed away the month prior. And she sat down and told us that just like you see in the movies, this was back on the East Coast, they had the reading of the will, where the father's attorney called all the children in and said, just to let you know, there is nothing left for any of you, and it's all going to charity. And that charity did not involve the children. It was just a direct bequest to charity, and he had never had the conversation with them. So needless to say, we don't think that that's ideal if the goal is to leave a nice, warm, fuzzy feeling with the children. Had that conversation been had earlier, it's not about what the intent of the father was. It was about not communicating that intent. So that's a conversation that never happened, and that left some very hard feelings on the part of the children. On the other hand, I think the opposite end of the spectrum is where we see even young wealth creators, maybe you've had a business liquidity event or something of that nature, bringing their young children into the conversation very early and really deciding that this is going to be how we as a family are going to function from a philanthropic perspective, and how we want to help impart our values or whatever it is that we care about, and let our children not only see us doing that, but be intimately involved with that process. And I think that's we've seen good outcomes with those types of conversations early.
Yeah, it's a terrific example, and one of the things that you keyed in on was this is obviously a very personal decision for every family, and there's no two families alike. But the more that you can kind of have that conversation and be upfront about those topics is typically the better. You brought up something earlier, kind of the idea of planning during your lifetime and having charitable or philanthropic intent specifically be more of the result of the end of your life, like you mentioned. So when you're thinking through kind of the idea between specific to something like a private foundation, in formalizing the idea of having a foundation, one of the other kind of important timelines to consider is something else that you mentioned, which is maybe selling a business or having a liquidity event. And there's obviously some strategies that are specific to how you would fund a formalized vehicle like a private foundation as the result of a liquidity event. Talk a little bit about why that's important to consider during a given year, which may or may not align sometimes with your philanthropic goals long term.
So I think, a lot of times clients will sell a business and then come in after the fact and say, we've sold our business, we paid the taxes, now we have the proceeds, and we'd like to start thinking about charity now. And what we really like to emphasize is, clearly we're here to talk about philanthropy, but certainly there are philanthropy, you can be both altruistic and also take care of your own family's financial situation by optimizing the way that you structure the timing of those charitable gifts. With that said, there are several vehicles that are out there, including private foundations, that will allow you to really offset the proceeds from the sale of a business using that charitable contribution in the year that you sell the business. So that's why we think it's really important, if you are going to have a liquidity event or anticipating selling a business or some other kind of wealth creation event, let's say, that you talk to your advisors about, what strategies might be out there from establishing a vehicle to help you on the tax side as well. I'm looking at the slide here. Go ahead.
Sure, no worries. I think that, and we're going to get into kind of some of those investment pieces here in a minute, but I wanted to spend a little bit more time on a really important piece that you brought up related to family. And what I hear from a lot of our clients is something like a formalized charitable giving vehicle, like a private foundation, can help really both lay the groundwork for someone's intention while they're still alive, right? It's a way to maybe introduce the families to some causes that they're really passionate about, that they'd like to see continued after they're gone. But the other piece, very specific to your story, is it can kind of help avoid contention with family members, heirs, et cetera. So I think that when we think about the terms of setting up something like a private foundation or a formalized charitable vehicle, these are things that really play into the decision because it's not just a short-term decision. It's many times a decision that's going to play out over the lifetime to come, right? So it's really important to kind of make those considerations.
And I think as far as contention, I think one of the real challenges is that a lot of philanthropic families are concerned, they don't want to have the conversation necessarily because they don't want to disappoint their children. And so it's really about how we frame the conversation, and you can always have an advisor help you with that, because if it's communicated in the right way, it really becomes a way to unify the family rather than to create misunderstanding. So I think that one family I can think of, they're on the third generation of running their family's foundation. And there are, grandchildren involved and great grandchildren at this point, and they all come together every year specifically to do that work. They do it a couple of times a year, but it's really neat to see that has, that legacy was created. But the reason why I think they're so successful is because it was just part of what they did as a family early on with their parents, with their grandparents. When we're at Thanksgiving dinner, we're going to talk about, what's important, what's impacted us this year, what are we thinking about? So I really think that, the sensitivity around not wanting to disappoint, particularly where there's going to be a large sum left to charity rather than directly to the children who might have an expectation. I think those are things that can be handled with the right dialogue.
Yeah, absolutely. It's a really good point. Let's shift our conversation, Simone, over kind of to the wealth management or investment side of charitable giving and specifically private foundations, because I think it's terrific to be able to highlight some of the things that you can do in a private foundation, and specific to an individual or family's financial goals, how those two things can really be aligned to maximize impact and fulfillment. One of the terrific things about a private foundation as a wealth planning tool for our clients and their advisors to explore is really this idea that it tends to be very control driven and flexible in what you can do. Not just considering kind of the grant making budget and what you can do with your gifts, but also on the investment side. So for our wealth managers who have become very seasoned in having these conversations around not just the charitable direction or philanthropic approach for their clients, but how those investment platform and how that their investments can actually line up with that as well. Talk to me a little bit about what you see some of the wealth managers who have done this very well kind of leverage as strategies for their clients, whether it's an idea of contributing highly appreciated publicly traded securities, or whether it's taking an approach from a risk mitigation perspective. Talk to me a little bit about how that conversation tends to play out.
Sure. I think, so I think simply put, contributions to a private foundation, if you are to contribute appreciated securities or property, are not going to be subject to capital gains tax, right? So it's a way of augmenting the charitable vehicle through a gift that is not subject to tax. It's also, for a lot of people, so for example, if you have a concentrated stock, or you've been an executive at a company and a lot of your wealth is tied up in a low basis appreciated stock, funding a foundation with that stock not only, again, allows you to leave a larger legacy to charity than selling it and paying the tax, but also can provide some tax benefits in the form of deductions that can be part of a larger strategy for unwinding positions or any other kind of tax exposure. So a little bit of something for everybody in funding a vehicle with appreciated stock.
Yeah, you know, one of the other things that I like to bring up specific to a private foundation is that it's very flexible, right? What's nice about a private foundation is the fact that it's a portable vehicle. So for anyone who wants to create and fund a private foundation, they can do so with the confidence of understanding that if they determine that that is not the right approach for them at any given time, they can liquidate that foundation, close it down, sunset it, and distribute those funds to either their favorite charities or to a donor advised fund or their favorite causes, et cetera. And the nice part about specific to consideration around, a liquidity event or a large funding event all at once is you really kind of can buy yourself some time in figuring out what your individual strategy is going to be. Not the case with many other charitable vehicles that are available to our clients, but a private foundation tends to provide a little bit more flexibility around those things. One of the, maybe I'll just share a story now because you kind of shared a terrific story earlier. I was actually presenting to an audience back when we could do in-person presentations several months back. And the gentleman who I was speaking after was talking about estate planning. And one of the things that he got up there and said was, he said, when you pass away and you die, your assets only have 3 places to go. And we call it the 3 F's, right? So he said, it's either going to go to family, which is, your children and your heirs. It's going to go to the federal government, which was the second F, in form of taxes, or it's going to go to philanthropy. And everyone in the audience kind of sat there. They sort of laughed and giggled because they really couldn't tell if he was being serious or not. Hopefully he wasn't, but it kind of made me laugh. But the idea it rings true, right? Those are really the only 3 places that your assets are going when you die. So dependent on what your individual plan is, engaging your children, engaging your family, people have very passionate ideas about how much of their estate that their children is going to get. Some it's a very large percentage, some it's none at all. And we've certainly seen some of those strategies swing drastically here over the last several years. But But the idea is it's usually a combination of all those things. The tax minimization strategy is usually fairly important for people who are considering wanting more control over where those assets go longer term. And in that case, it kind of, how do we get that second F to be as low as possible? And then maybe deciding what's going to work for our individual case between the family and the philanthropy piece.
One other thing I just wanted to kind of touch on, I've had two situations, one of them you and I had talked about, but where clients passed away unexpectedly and prior to executing on their philanthropic plan. Two separate clients wanted to start foundations, talked about it, I'll save it for another day, and passed unexpectedly. In those situations, it really, and I only say that because we really do have to think about the time is now. I think this year, unfortunately, has reminded us that we are mortal and we don't know when the time is coming. But it's a shame to see that somebody who was very specific in what they wanted just didn't take that step and didn't follow through, and ultimately the result was not what she had intended in one case, and in the other same thing. But
Sure.
So just a reminder, it's not a complicated thing to do. It just takes some attention and some vision. Usually advisors can help with the vision. I think the more that you engage with your advisors or others who are philanthropically inclined, the more you can learn about what the options are. But I think that it shouldn't be, the complexity should not be a bar, because it really is not as complex as is often understood. So.
Well, thank you for saying that. Obviously, that's the goal of Foundation Source, is to make that process as easy as possible.
Yeah.
For both our clients, our prospective clients, and their trusted advisory team. Before we move off the topic of foundation investments, we obviously talked a little bit about kind of incoming investments to the foundation and how, risk mitigation. For some reason, I have a real challenge with that word. I don't know why. But let's talk a little bit about a couple of the strategies that can actually be employed within a private foundation. One that comes to mind that's certainly gained a lot of traction here in the most recent years is something like program-related investments, or PRIs as abbreviated. It's obviously a topic that is a little bit more specific in the direction of how a client may choose to kind of interact with their estate plan. But when that topic or something like it is raised for advisors, where do you typically point them?
Typically to the financial advisor, right? So there are a lot of financial advisors who are very well versed in how to manage foundations and the intricacies. And that's not something that an individual or a family should feel is a burden that they need to learn how to do that. This is handled by professionals, and there are many very well-versed financial advisors who can manage that.
Yeah, it's such a good point, because it really brings up that idea that having working with a wealth advisor on this conversation is just so important. For example, program-related investments, and I know that there are probably a good portion of people on this webinar that are familiar with them, but for those that aren't, they're a really important strategy that are becoming more and more commonplace within private foundations. Really, this is the idea of leveraging not just the grant-making budget of something like a private foundation toward charitable intent and impact and fulfillment, but also leveraging the investment component of the client's assets as well. To specifically program-related investments, there's really three types. There's the means to make equity program-related investments, which is the means for clients to actually take a percentage of investment in a for-profit company that is focused in charitable giving or philanthropy. Other types of program-related investments include loans, maybe low-interest loans to their favorite charitable institutions, as well as loan guarantees. So I know that as part of our follow-up to this session, we're going to be sending everyone some terrific resources, and I'd really encourage everyone to verse themselves on the idea of program-related investments, because they're certainly terrific tools that can show a lot of impact for our clients. So Simone, maybe let's move on. We've talked a lot about kind of private foundations as kind of a standalone vehicle and what they can do and why they're important for family, for investment, for creating impact, for leaving a legacy. Let's talk a little bit about how private foundations in the conversation of planning interact with other charitable giving vehicles, other wealth management strategies that are available to our clients. Obviously, some of the things that come to mind are making direct gifts, utilizing donor advised funds, leveraging things like charitable remainder trusts and charitable lead trusts. I know something that you've spoken a lot about, and certainly not directly related to a private foundation, but as far as an overall plan are things like pooled income funds and IRA distributions. So maybe talk a little bit about how you see clients who both have a private foundation and also clients who are exploring a private foundation utilize these additional tools at their disposal.
Sure. So I think that there's a place for everything, and it doesn't have to be binary, right? It's not this is what I'm going to keep in my personal account, and this is where, and then I'm going to fund a private foundation with all the rest. A lot of times, depending on a client's specific goals, there's a place for a few different vehicles, right? So it's a little bit of an art, and this is where advisors can typically help determine, what is it that you're trying to accomplish. So if the goal is, look, I want to maximize my wealth transfer to my children, but I also want to have a charitable vehicle, right? And I think there was a question from someone in the audience about what do we consider high net worth. That changes all the time. Back when the exemption, the estate tax exemption was $675,000 when I was in law school. I think it was probably anything over that, and then now we've got it about almost 11 and a half. So it's typically clients with taxable estates, so that moves around. But again, these strategies are available for even clients without taxable estates, right? There's a philanthropic piece that is independent of the estate tax piece, and also has income tax benefits. So, but back to the different strategies. So for example, a private foundation is not going to provide any cash flow or income stream to the grantor, right? To the family. So sometimes we'll have a client say, I've had this liquidity event. I want to fund my foundation, but I also want to, retain some income. I would like to have income coming to me, and I would like to have some assets passed to the children. So examples there, charitable remainder trusts and charitable lead trusts. Both of those dovetail nicely with private foundations. A charitable remainder trust would essentially have the remainder going to the charity, so it would provide an income stream for life to the family and or the children, the grantors and or the children, and then ultimately after the passing of the last income beneficiary, that would go into the foundation. So that's one strategy. A charitable lead trust is a way to pass assets out of the taxable estate in a tax favored way from an estate tax perspective. But with funding a charitable lead trust, the distributions during the lifetime of the grantor are actually going to charity. So those can go to the foundation and then pass the assets ultimately that are left to the other heirs. So those are some nice ways. A pooled income fund is similar to a charitable remainder trust, where you can take an appreciated security, put it into that fund, receive an income stream back for your lifetime or the lifetimes of others, and then also the remainder will go to charity. But I think that, so those are discrete pieces of sort of an overall plan that can work very nicely together. With the IRA distributions, we know that clients can make the qualified charitable distribution. You cannot make that to a private foundation. That has to go directly to a public charity. Right. You also cannot make that to a donor advised fund. A donor advised fund is, for those who are not familiar, a vehicle that is similar to a private foundation, but without the control that Josh talked about earlier. So essentially, it is itself a public charity. You set up that account and you can make grants only to other public charities, 501c3s. So you are more limited in your ability to to grant. You don't have the same flexibility that you would have with the foundation, but certainly place for everything.
Sure, sure. No, well said. And I appreciate you providing that overview, Simone. We actually did our previous webinar. My colleague Justin hosted the topic of comparing private foundations and donor advised funds, which is really important, obviously considering year-end planning. Understanding the differences between what you can and can't do with both of those vehicles is really important. I don't want to spend a lot of time on that because we really kind of went into detail on that, but some of those other strategies that you talked about, I would like to kind of jump in on very briefly. I know, especially given 2020 and the changes that we've seen this year, namely the CARES Act, what that's done for this kind of strategy of leveraging maybe both a private foundation in addition to direct giving to your favorite charities. The IRS has basically said, hey, we're going to kind of lift that maximum on the AGI contribution and what you can do given this time of year for your direct giving. So what we're seeing is a lot of people that are kind of maxing out their gifting to a private foundation to that, 30 or maybe 20% of their AGI, but then they're going in many cases up to 100% of their AGI in direct gifts to their favorite charities. So it really is a unique concept that we're kind of seeing take place this year, especially on that direct giving front. One other note on kind of the CRT and CLT, a lot of our clients love the idea of kind of stretching control longer term by leveraging a charitable remainder trust or a charitable lead trust in conjunction with a private foundation. In essence, instead of the traditional thinking of naming a specified charity as the beneficiary of one of these charitable trusts, the idea being that you actually name your own private family foundation as the beneficiary of one of these tools. Therefore, you're not, in essence, kind of dropping a very large sum of money on one or a select group of specific charities, but leaving that in the control of your family longer term. So it is a terrific strategy that I would certainly encourage everyone to explore with their, with their specified advisory team as well.
And I think, Josh, if I could just add, for anybody who's on the call who's not terribly familiar with the foundation, the requirement for a private foundation is that it distribute 5% of its assets per year, right? So
right. So that it's actually a great point. It's the minimum distribution requirement. You'll see it abbreviated as an MDR quite often. It's actually 5% of the prior year's average asset balance prorated. So a lot of people are nervous about who fund a foundation or are nervous about having to kind of get cracking right away and start making these distributions, but you really do have a lot of time at your disposal because it's based on the prior year's assets. For the majority of people who are starting a private foundation, that really isn't even a consideration for the first 12 months or so. So
that's a great point. That's a great point, especially year-end foundation.
Absolutely. It's kind of this idea of, okay, we're going to put all this money into a private foundation. We have all these terrific charitable goals, but we don't know where to start.
I did say everyone should talk about it at Thanksgiving dinner, but maybe not as a fire drill. So.
That's true. You'd actually be surprised how much, what a huge percentage of our clients actually make their gifting decisions around Thanksgiving. And it'll be interesting to kind of see how that strategy plays out this year, with Thanksgiving potentially being a little bit different than it is in the past. So Simone, let's switch topics just one more time here to kind of our last piece, which is talking a little bit about this idea of contributing specialty assets to a private foundation. You kind of touched on it earlier, but sometimes people want to, obviously we know we can contribute cash and we can contribute highly appreciated securities, and those tend to be terrific strategies from a planning perspective. But sometimes clients want to, in their overall legacy planning, consider things like real estate and contributing land and even tangible property or private equity. Sometimes they want to even contribute property and real estate for a specific charitable use with their intention. So where are you having these conversations with clients who have one or several of these asset types as a part of their gifting strategy?
Yeah, and I think that's really that's a great point too, because a lot of times when we're thinking about these things, we simply go to cash or our investment accounts, right?
Right.
So I think it's really important to recognize that whatever the makeup of somebody's asset mix is, that there's usually a way to fund the foundation using some of those other assets, depending on what the use will be and depending on whether the intent is to sell or hold or whatever it is. But that's something to definitely talk with your advisors about, because there are a lot of different options there. The other one we hear a lot, we hear from art collectors all the time, right? So definitely don't think only about your liquid investments in terms of what you can use to fund that foundation.
Right. It's a really good point, and these end up being kind of some of our favorite stories, right? The idea that you can, I have clients that have artwork collections, that have classic car collections that are held as assets of their foundation. I have a client that has a collection of antique horse saddles as a asset within their foundation. We have a client who holds a search and rescue helicopter as an asset of his foundation that he actually uses from a charitable perspective to kind of embark on these search and rescue missions. So these are incredibly personal.
Zoos.
Yeah, absolutely. Real estate is kind of one of those specific asset classes that does have kind of some specifics around it. It's important to talk through what that looks like. But that said, real estate investment can be a terrific means to grow an already successful charitable investment platform outside of just kind of your traditional investments in a private foundation. Anything else on the kind of the tangible property side that you wanted to kind of bring up before we move on? I know we're getting kind of close to the end of our time here, and we want to make sure we leave a little bit of time for questions. Unless you have anything,
I think you covered it. I think the idea is just to be mindful that if you do have other assets out there that are not necessarily with your financial advisor or in your brokerage account, that doesn't limit you.
Sure. No, it's important. And I know we have some terrific white papers specific on tangible property, real estate, land, et cetera, that we can certainly send everyone and follow up to this. So Christy, that said, maybe it'd be a good time to kind of hand it back to you for the last few minutes here and address any questions that have come up.
Yeah, we've received quite a few questions. The first one was more of a comment than a question. It was somebody who said that they just received some money for their business through the CARES Act this week and wanted to thank you for bringing that up and because it is something that is very relevant right now. There was kind of another COVID-related question, kind of in terms of, we know we're having more of these conversations, but what specifically are we seeing, or maybe how have foundations pivoted, changed some strategy in 2020? So Josh, you want to take that?
Yeah, absolutely. It's a great question, Christy, and obviously this is a year unlike anything that we've seen before, and we've certainly seen pivots within our business. Some examples that obviously jump to mind are we've seen an incredible uptick in our clients and prospective clients even who want to make grants to individuals and hardship grants to individuals. We've seen clients who have taken a huge uptick in their giving around the areas of research. We've seen people who have wanted to increase the amount of international grant making that they're doing this year, all as a result not just of the COVID pandemic, but some of the other events that we've kind of seen unfold this year. So tossing that over to you, Simone, I think that from an overall kind of wealth strategy or wealth planning perspective, I know you've probably seen some conversations change a bit as well.
Well, that's right, and I think I sort of touched on it earlier. Unfortunately or fortunately, we're all slightly more aware of the uncertainty that goes with living, and so I think between the pandemic and the election this year, and the uncertainty around the estate tax, we're having a lot of conversations that are more urgent, let's say, from the client's perspective. So really a good time. People are seem to be more engaged with wanting to look at getting things accomplished. I think the volatility in the stock market earlier in the year. We all hear about these so-called black swan events. Well, we just had one, and so all these times that we've thought, well, this wouldn't happen to me. We hear it all the time.
Right.
I have all my assets in one stock, and I love my stock because I love the company, for example. That would never happen to me.
Sure.
Now, even if it didn't happen to those clients, there's a little bit of a different perspective on maybe a little bit more cautious perspective that's driving some of these conversations to get things executed.
Yeah, you bring up a good point. It's kind of it's a great thing for maybe not the best reason, right? It's terrific that a lot of our clients are maybe using this as kind of that kick in the butt to reevaluate their estate plan. Things that people like you and I are preaching on a regular basis. Have this conversation, have it early and often. Unfortunately, sometimes it takes events like we've experienced this year to really have someone realize that, hey, we really need to get this in line. We need to make this a priority. It can no longer be pushed off for, to a TBD time in the future.
Yeah, and I think the other thing too is, fortunately or unfortunately, a lot of us are spending more time at home with our families, having different, more in-depth conversations. The priorities have changed a little bit this year, and our availability to focus on these things, I think, has changed a little bit. Whether it's commute time that is no longer there, or however people are having more time in their schedules to kind of regroup and kind of ground themselves in these types of topics. So
great point.
Great. So a question did come in that I just want to make sure that all of our attendees know. So someone asked if they can listen to the replay of that private foundation and donor advised fund webinar. And yes, absolutely. We have all of these webinars recorded. And so I'll throw at the end of this our information email, and if you're interested in that, you can send it along to us. There were a couple questions that came in kind of about, and I'm going to wrap them together, even though they're kind of two separate things. But the first is, talk a little bit about contributing an IRA or a Roth IRA into a private foundation and why that might be advantageous. And then the second is, somebody asked about, can you invest funds of the foundation to make more money for the foundation? So I'll toss it out to you guys. You can determine who wants to answer.
Yeah, no problem. I can start, Christy. And obviously, when you're talking about something specialized like IRA contributions, it can differ between a standard IRA and a Roth IRA. So certainly a strategy that you want to have at a very specific level. The benefits of those types of contributions are obviously the idea that you can kind of avoid estate taxes and avoid some of the taxes that come along with that upon death. Not necessarily maybe the best strategy during lifetime for IRA contributions, specifically to a private foundation or another vehicle like Simone mentioned, but kind of from an estate planning perspective, longer term, they can be terrific strategies. Anything you wanted to add on that, Simone, or it's pretty straightforward?
No, I think that's pretty straightforward. Yeah, those are good testamentary gifts, but during your lifetime, that qualified distribution could go to a public charity, but not a private foundation.
Right.
And then I think there was another question. Go ahead. Sorry.
No, that's fine. Christy, I'm sorry. What was the second piece to that?
Yeah, just in terms of talking about what kind of investments you can do with the assets of the foundation in order to continually build up the value of the foundation itself.
Yeah, it's a great question, and it tends to be a very personal decision. The idea around, hey, some people take the approach of putting money into a private foundation and they want to get as much of that corpus out there from a gifting or a grant making perspective or a programmatic perspective as they can. Others have maybe a more traditional private foundation view on investments, which is to make contributions more in line with that 5 or 10% distribution every year, with the remainder remaining invested. The idea being we want to grow that corpus just like any traditional investment platform, the same applies to the foundation, whether that's standard investments in the stock market and cash and real estate. The idea being we want to continue to increase the amount that we have to do more with, right? One of my passions, Christy, and I know you know this about me and Simone does as well, but this idea of entrepreneurial philanthropy, which is a completely separate topic that we could spend another hour just cracking the surface on. But the idea that you can use not just your investments, your cash and your securities toward your philanthropic mission, but the idea of taking what's made you as an individual or you as a family successful from a business perspective, or the personal philanthropy that you're engaged with outside of grant making, and really apply that to kind of using $1 to create $100, right? It's the same concept from an investment perspective inside a private foundation. How do we turn $1 into $100 so that we can help that many more people?
And I think I would just add, so typically a foundation will have an investment policy statement, right? Where they, whatever the goal is, I think Josh mentioned that it depends on the goals of each foundation, but typically there will be some kind of parameters for how those assets continue to be invested based on the desires of the foundation.
Yeah, it's a really good point. And again, Simone, another great reminder to have that conversation with your trusted advisory team and why that's so important.
Right.
Yeah, absolutely. So I think we have time for 2 more questions. There are still a number that we didn't get to, and like I said at the beginning of the webinar, we will definitely follow up with everyone individually, especially for some of the more specific questions that were asked. But 2 I wanted to make sure that we get to. The first is, what is considered high net worth? Or I guess if we're going to drill down a little bit more specifically to private foundations, at what point does a private foundation make most sense? Is it still that $5+ million that everybody always thinks about, or especially thinking about starting it now, but maybe completely funding it via? I'm giving you a complete lead in here.
Sure.
Starting it now and then truly funding up.
I appreciate it, Christy. And I know Simone kind of already touched on the first piece of that, kind of what is high net worth, or I get the question also, what is kind of ultra high net worth? If one is high net worth, what is ultra high net worth? They do tend to be kind of moving targets. For the most part, what I hear is kind of that, $5 million versus $20 million in investable assets, Simone. I know you probably see that as a moving target as well. Specific to the idea of kind of when should you start a private foundation, the methodology has changed quite a bit in the last 20 years. I think that for a long time, private foundations were really considered a vehicle reserved for those who were going to contribute, 5 or even 10 or $20 million initially. The nice part about Foundation Source is we've really tried to make that a goal of ours to pull that barometer down and make a private foundation more accessible to people who want to have the control and flexibility as part of their long-term plan, but do so at a much lower entry point. So as you know, Christy, we kind of use $250,000 in initial contribution as kind of our good place to start the conversation. Now, am I saying at $250,000 that's going to be a perfect fit for everyone? No, just like I'm not saying that a private foundation is going to be a perfect fit for everyone at 10 million. It really is kind of a personal decision that you need to work through, leveraging your conversations with your trusted advisory team. Simone, is that kind of in line with what you would say as well?
Yeah, I was just going to say, I think that the distinction is you don't have to be high net worth by any definition, whatever that moving target definition is. It's really about what your personal goal is, right? So we see some people who, they may have $1 million, but they don't have any heirs and they are really interested in doing something. And so, again, there are some people who do this very much motivated by estate tax planning, but I would say most are doing it for pure philanthropic reasons, or many are doing it for pure philanthropic reasons. So don't have to be high net worth to engage in that process.
Great, thank you. And I think I saw somewhere that if you took all the foundations in the United States, the average foundation size is just about a little over $700,000. So that just gives people a little bit of perspective. I'm going to ask this last question because I do think it also gets to the heart of private foundation versus DAF, or as we like to say, or we see more frequently, it's private foundation and DAF. So a question came in about how can you use your donor advised fund kind of to help you achieve that 5% MDR in a given year with a private foundation? Is it possible to contribute directly to your DAF from a private foundation?
Yeah, great question, Christy. And we touched on this a little bit earlier, right? One of the best parts, in my opinion, of a private foundation is that flexibility, right? Knowing that you can make a contribution to a private foundation, and you're not, to your point, Simone, earlier, you're not in this immediate goal to have a completely full-baked philanthropic plan for you and your family. So the idea of utilizing a private foundation and a donor advised fund is a strategy that we're seeing with an incredible amount of growth, whether it's because they'd like to use their donor advised fund as kind of that overflow valve or their private foundation to make sure that they're hitting their 5% distribution requirement, or if they'd like to use it as a thoroughfare for a truly anonymous gift that they'd like to make. There's several strategies, and we could spend the next hour at least talking through kind of the benefits of a private foundation and a donor advised fund. But to directly answer your question, it really is this idea that you can make a gift from your private foundation to your own donor advised fund and satisfy that minimum distribution requirement of your foundation. So Simone, anything to add there?
No, I would just add, I think that oftentimes when clients are thinking about both, the question comes up of, can I just do a donor advised fund and then roll it into a foundation instead of the other way around? So you want to speak a little bit to that?
Yeah, it's actually a great point. You know, one of the cautionary things that I always use is, you know, Simone, I'll get at least 10 calls from wealth advisors every single February. And the conversation kind of goes something like this. It says, you know, hey, Josh, we had a client. They had a liquidity event at the end of the year. We needed to do something quick. We took $5 million. We put it in a donor advised fund. And now we're having a further conversation with the client, and they want to make scholarships, and they want to gift internationally, and they want to run a charitable program. And, you know, how do we get that money from the donor advised fund over to a private foundation? Unfortunately, I have to tell that advisor they have to have a somewhat uncomfortable conversation with their client because you really can't go that way, right? Where you can move money at your discretion at any time from a private foundation to a donor advised fund, really can't go the other way with few exception. So the idea of, a lot of people kind of use this idea of starting with a donor advised fund, which is terrific. And donor advised funds are incredible. They've done an amazing, they've created an amazing platform for people who otherwise may not have the means to formalize a gifting strategy for themselves or their family to do so. That said, I kind of challenge that idea of maybe it's actually better to start with a private foundation and then consider a donor advised fund because of that portability factor.
Exactly. And that was really the point, because it happens all the time. And so just know that if you are, you know, doing some 11th hour pre-liquidity planning for a business and you're thinking of which vehicle to choose, if you do go with a foundation, you have more flexibility to then go to a donor advised fund, and it does not work the other way, just like Josh said. So thank you for that.
Well, it's a great point, and I think that leads me to kind of one thing that I'd be remiss if I didn't mention as we do near the end of the year. If you or any of your clients are interested in creating a private foundation in 2020, our cutoff for any new foundations that are going to be funding with anything other than cash is December 23rd. And then if a foundation is going to be created with cash or not funded in 2020, we can establish that up until December 31st. Now, I'd say don't wait until December 31st, but we can do it in the morning. But I'm
going to pull my hair out, Christy.
If it was,
I'm glad
if it was absolutely, that's what I said. Don't wait.
I'm glad that's Josh's job. My daughter's birthday is December 31st, so Glad that's in your world.
Yeah. You want all your business done before that. Yeah, exactly. But those are our deadlines. If you have follow-up questions, please reach out to us. And I just want to say thank you so much, Josh and Simone. This has just been a wonderful conversation. We had a lot of questions that come through, and that to me is always, an indication of kind of if we hit the mark. So if you have follow-up questions, please email us, info@foundationsource.com. Our phone number, 800-839-0054. Don't forget that there are these 2 handouts in the dashboard. And we also have white papers on all of the things that we talked about today. So if you would like additional information, please reach out to us. So thank you all for attending today. And with that, that concludes today's broadcast. Thank you so much.
Thank you so much.
Thanks, everyone.
Thanks, everybody. Thank you. Bye-bye.